One of the most important macro signals just flashed again. The yield curve is steepened by almost a full percentage point in 2025, coming out from one of the deepest inversions in modern financial history. The last time we saw this exact pattern was in 2019, in 2007, and in 2001, and in each of those cases, a recession followed shortly after. In fact, going back to the 1970s, a steepening yield curve is a perfect 6 out of 6 track record of predicting an economic recession. Yet today, a year after the signal first appeared, the economy still looks strong. US GDP grew by 4.3% last quarter, and the stock market is still hovering at all-time highs. Many are now arguing that this notorious recession signal is no longer relevant and has broken its perfect track record for the first time in 5 decades. But first, a very brief rundown on what the yield curve is meant to be and why a steepening is meant to coincide with a recession. The yield curve takes longer-term bond yields, like the one you get on a 10-year Treasury bond, and shorter-term bond yields, like the one you get on the 3-month Treasury bond, and it looks at the difference between them. This is what it looks like. This is the yield on a 10-year note minus the one on a 3-month note. Now, most of the time you have the 10-year yield that is higher than the 3-month yield, so the yield curve is positive. You get paid more for locking your money up longer. But when the Fed pushes short-term rates high enough, the curve inverts and its assigned policy has become restrictive. Borrowing becomes expensive, credit slows, and eventually economic growth weakens. Then, as a recession approaches, the curve usually steepens again because the Fed begins cutting short-term rates in response to rising economic stress. And indeed, today we are also seeing signs of economic stress. This chart shows the yearly change in leading economic index. It combines forward-looking data, things like credit conditions, building permits, and new manufacturing orders, to give us a sense of where the economy is heading. And right now, it's been sitting in negative territory for a couple of years. That tells us economic momentum is already slowing beneath the surface. If we zoom out, periods where the index drops into negative territory also tend to be followed by periods of economic recession. And one of the most important parts of the economy, the labor market, is starting to show cracks as well. The unemployment rate is now at 4.4%, which has risen by more than a full percentage point since 2023. Moves like that are rare in a truly resilient economy. In fact, when we look back, similar increases typically appear ahead of recessions in 1990, 2001, 2007, and again in 2019. And historically, the labor market and the yield curve move together in a very intuitive way. When unemployment is low and the job market is tight, the Fed leans toward a tighter policy, which often pushes the yield curve into inversion. When the job market weakens and unemployment rises, the Fed shifts the other way, and that's when the curve starts to steepen again. And that relationship hasn't broken this time. We saw deep yield curve inversion in 2022 when unemployment was near historic lows, and now we're seeing the curve steepen as unemployment moves higher. In other words, the yield curve is still behaving exactly the way it always has. But the real question now is why the economy is still growing and a recession hasn't been declared yet. Well, the answer lies in one key metric: total job openings. In 2021 and 2022, we had one of the hottest job markets in history, with more than 10 million job openings available. The Fed then began rising rates and the yield curve inverted, and job openings fell by roughly 30%. However, because the starting level was so elevated, even after that drop, job openings were still higher than to pre-COVID levels. And today, job openings have stopped dropping and just stagnated for over a year as the yield curve has steepened. That puts us at an important pivot point. If the Fed continues cutting rates, pushing the yield curve steeper, that could help revive job openings and potentially push a recession further out. But the problem is Fed Chair Jerome Powell is signaling that we may only see one cut through much of 2026. The reason comes down to the Fed's second mandate. Beyond supporting employment, the Fed is also tasked with keeping inflation under control. Lower interest rates make borrowing cheaper and encourage spending, which is great for growth, but it also risks pushing inflation back up. And while inflation has cooled significantly from its 2022 peak, it's still sitting above the Fed's 2% target. In factors like tariffs, the Fed is wary of easing too much. If the Fed pauses or cuts less than markets expect, short-term rates could stay elevated, and that would risk pushing the yield curve back toward inversion, which could once again weigh on the economy. However, if we look at a major inflation component, oil prices, they've fallen sharply and are now sitting near some of the lowest levels of the past 5 years. Oil plays a major role in inflation because it's used for fuel. When oil prices rise, fuel becomes more expensive, causing shipping shipping costs to jump. Factories then face higher input costs, and those increases eventually show up in consumer prices. So if oil prices and inflation stabilize or continue easing, the Fed may have room to cut rates and support the labor market a bit longer. And if that happens, this cycle could start to resemble the one major historical exception to the yield curve rule, 1967. Back then, the yield curve inverted, and even though inflation was still hovering around 3%, the Fed chose to cut rates early to support employment. Unemployment actually fell for about a year, and the recession everyone expected didn't arrive right away. But it wasn't avoided entirely. Once inflation resurfaced and the Fed was forced to tighten again, the downturn eventually followed. The pattern wasn't avoided, just pushed forward. So now, this doesn't necessarily mean the yield curve is broken. What's different this time is the size of the labor market cushion, and the fact that the Fed stepped in earlier than it usually does. Those two factors have likely delayed the downturn, but they haven't eliminated the risk completely. And for investors, that means watching inflation trends, labor market, and how long the Fed can keep easing without losing control of prices. At Capital.com, we'll continue tracking the signals that matter and what they mean for markets. Thanks for watching.